Okay, so I know that we're stuck for time, and I don't want to take the stage and hog the time away from my colleagues here from KPMG. This is an important topic. The room should be fuller, to be honest. There is a lot of opportunity to do good here, so pay attention. I will be looking for questions from the audience, okay? So start thinking from now, and then at the end, we'll have time for your questions, and we'll want to squeeze as many in as possible. With that, no further ado, Dirk, Yash, go ahead.
Thank you very much, Andrew. So how do we do this in order to not obstruct the view? Sorry about that. Okay, there we go. So we're talking about financial disruptions, navigating financial disruptions, and I think we thought about the title sometime earlier, but it's becoming more current as we speak. It's becoming more current by the day. And within all the measures that you could take to navigate financial disruption, we are zooming in the area of recovery planning, because as we see across the globe, we see movement there, and we would just like to discuss with you and share with you our thoughts about this subject. Right. Brief structure. We will. You take care of this. So we will talk first about the changes to the risk framework, the risks that we see in the world. Then we will zoom in on recovery planning, and we'll take a global view. This is a global issue. The risks that we are talking about are global, but there's local solutions to them, and we will discuss the local solutions that exist. This thing permitting. Can you go back? Then we will dive down into the intricacies of what makes a good recovery plan as outlined by the different regulators. Sorry, this is really annoying. Plan and anticipate of what will happen once the regulator is in the boat, for better or worse. The second element of a recovery plan would be KPIs, indicators of where you stand. First of all, when the recovery plan kicks in. Of course, that is decided together with the regulator. And then how do you monitor progress against your target of recovery? Thirdly, even before such a recovery plan gets executed, you need to stress test this. You need to make sure that it even works in situations of stress. And it will only be applied in a situation of stress. So it must be a very thorough stress test scenario that you implement. And finally, you should describe your options, and you should describe the recovery capacity. So what is the content, what is the mechanism by which the recovery actually acts on your KPIs? And it's very important, and the regulators are really after this, that this is not a Word document in a drawer, but this recovery plan is filled with life, and that the operational, the process, and the data capabilities are created for this plan to work. Just think about the KPIs. You need to produce KPIs in a stress situation much more regularly than you would do in your quarterly or annual report. But you need to produce these numbers reliable to monitor progress. And so a recovery plan is not just about a procedure, it's also about creating the capability that this procedure can actually work. Right, with that, I think I would hand it over to you, Yash.
Thank you, Dirk. So yeah, as Dirk rightly just said, so that there are, can you just go to the previous slide? Yeah. So as you can see, there are 5 key pillars of a recovery plan. So currently today we are going to cover the 3 pillars, which are the indicators, the stress testing, and the options. We'll be talking about them in more detail given the interest of time. And just to give you a brief overview, so while many of the geographies are currently in the process of implementing recovery plan, I would just like to ask in the audience maybe why there is a need for a recovery plan. I know this is something not in the this is something which is not being implemented in India, but if anyone would like to guess what is the need, how is it different in the existing regulatory framework to, which are there to prevent such a situation. So what, anyone, maybe the need or what might be different than the existing frameworks which are there? Anyone in the audience?
Hi, thank you. There's always risk and scenarios happening like COVID, financial crisis, everything. And no matter how much you put as a preventions, things happen. So having a recovery plans, having a clear mindset, okay, something bad has happened, how to get over with it is really important. I think it's a
Correct.
good, it's a great idea, great thought, but
Yes.
I think it's really important.
So as rightly said, so while we do have existing framework to prevent, from such a situation, but at the same time, we do need to be prepared that if such a situation happens, how the companies are going to deal with it. So you need to have something in place or, some mechanism in place to recover from that such a situation, early on. And that would help in a faster recovery and, avoid trouble, government bailouts. So it is more of a rather than a preventive mechanism, which I would say that our existing frameworks do. This is more of a how, if the event has happened, how are you going to recover from such a situation? So we'll just go a bit detail for the indicators, test testing, and options, and then let's see how it goes. So here we are trying to highlight what all geographies. So as Dirk rightly mentioned that geographies have already started on implementing recovery plans in their regulations and all. So while we have tried to cover geographies in the sense that something in Middle East, something in Europe, Western US, and everything. So some of the key features in the indicators which we see is that everyone have had their different approach. So when you go in the UAE, the indicators which they are asking companies to monitor are revolving around capital, liquidity, profitability, credit risk rating, and reserving area. While these are the broad headers, the regulator has gone down to situation where they are asking each specific indicators within each of them. So within capital, you need to monitor your SCR and all, and you need to have thresholds, right? To on which threshold, what will be your line of action, what will be the recovery options if you are going to breach such a threshold, or which threshold should you breach. So while each geography has adopted a bit differently, while where UAE goes on a very prescriptive and gives out on each indicator, Europe in the European market, IRD has issued regulations and they just give out that you need to have monitor capital and liquidity indicators, asset quality indicators. Now, what those indicators in itself will be, that will remain the company's choice. They are not prescribing them, but yes, that is how. In the Singapore also, again, they just say that you need to have the quantitative indicators and qualitative indicators, but they are not specifying which particular indicators are to be monitored. So that is how the situation is going on. In the US also similarly, while they do not have a particular recovery indicator framework in place, but it is more linked to the existing ORSA or capital practices. On the right side, as you can see, there are two types of threshold. So the regulators do specify through two thresholds, which is the early warning and the recovery threshold. So the main purpose is that early warning threshold is that company needs to identify the stress early on. If there are such a situation, they can act early on upon it, and the options which they might be using to recover from such a situation might not have that large of a operational implications, right? So, and once the recovery threshold is breached, I mean, company is on the verge of insolvency. At that point in time, you just have to go to the regulator. Regulator will have a say on everything. You will have, so to avoid such a situation, there are two thresholds which are being prescribed by the regulators globally. Next. Any questions anyone might have on the indicators front? If okay, now.
Can you please try?
Okay, now coming on to the recovery options. Now, let's say there comes a scenario where, indicators are reached. So, as we were discussing earlier, there are 5 key elements of a recovery plan: the governance framework, the indicators, and the third part comes on to the recovery options. So, as part of the plan, the companies need to identify few of the recovery options for which they will have some arrangements in place. So it's not just a document which you need to draft, write literature and just keep it in a corner, but you need to have some recovery options in place, right? So some of the common recovery options we have already listed out: asset sale, borrowing, recapitalization. Now again, while all these are listed out, it's not that these are the fixed options, but these are the options which the company will be the first go to, and for which the companies need to have some arrangement in place. So for example, asset sales, so they must have identified some sort of assets that, okay, these are the some of the assets. Let's say there comes a situation whereby we are in the need of a liquidity, then these are the assets which will be the first ones to be disposed of to have a liquidity bump sort of. So every company will need to specify, while these are some of the mentioned ones, but obviously there can be a number of recovery options. Now, one more key thing which needs to be kept in mind is that not one size fit all. So not necessary that, so for example, taking recapitalization as an example, not a company in the need of capital, right? A company who is now on the verge of insolvency. Now, what will be the recovery options to be chosen? If the company is being governed by a group company, larger company, uh, recapitalization might be an easier approach, whereby they approach the company, group company, to say that, okay, we are in such a situation and please help us with some sort of capital infusion and all, and that can be a preferred option. But for a standalone company, that might not be the case. For them, the company might need to rethink on the business mix. They might, if the situation goes worse, they might need to close down the new business. So again, that situation will vary on company to company. Now, what option is to be chosen? First, it will depend on what sort of a stress situation you are. Are you at a recovery threshold, liquidity crisis? Is it a profitability crisis? Is it a capital crisis? What sort of crisis? So again, stress situation will define, and to what extent you are deep into the crisis. So that will depend on what the option is to be chosen. The second constraint goes in the deployment time, regulatory compliance, what are the capacity for each option. So again, those will, each option might have a different capacity. So from assets, I might be getting, let's say, 10 million, 20 million, 100 million. Borrowing, I might have access to 200 million of capital. So again, what sort of capacity each option has, that will also play a role, and what is the need of the hour. And the main two things which I believe will be the key deciding factors are the operational and second order implications. So while let's say that a company is in a insolvency position, now one of the option preferred by regulator may be that, okay, close down the new business, don't write any new business. But that is something I don't believe any company would want to do that, right? So again, what sort of a option you want to choose? If the company is taking too much risk, they are selling protection business all year round, now they have a good exposure to risk. Now the regulator is saying, or the company's indicators are showing that, okay, that it is going out of my RAF, and I need to dial down a bit, right? Now, do I want to do that? So operational implications will have a uh, big say in what recovery option is to be chosen. So again, so these are my bet on recovery option. Anyone, and if anyone would like to add any options which they think will be more appropriate, or something which is being missed, happy to hear that. So here we have just created a sample illustration on what the stress testing section looked like. So as I said that Now we are going on to the third pillar, the stress testing. So I've just created two hypothetical scenarios whereby let's say there is a company who is going on in the solvent position, good. Now there comes a situation whereby they are facing some challenges due to XYZ constraint, maybe change in business mix. So as Dirk finally said that there are new age risk change keeps on changing every day, and the company is now facing challenges. They, in the first situation, they might not have to go into taking an aggressive option. They might just ask for some support or from the group for recapitalization, or might borrow some money for the time being, and they might come into the green, right? They might have to change their reinsurance options, but nothing which might be having any implications on their business as of yet, right? So that is the benefit of the early warning threshold. So if you have an early warning threshold and a recovery plan which is in place, you will obviously first apply a plan which will have the lowest impact on your operations and will help you cover up as quickly as possible. Now, the second situation comes in where the company is in a more deeper crisis, and now we are in a more towards the insolvent position. Now, in such a case, again, the company might need to go for the options which might not be preferred, but the need of the hours, closing of new business, bringing in new shareholders, something which is not a preferred option, but yes, they have to do it. Now, again, the capacity and the operational implications will play a role. So in such a situation, you might have to inform the regulators, and again, that is how you have to do it. But that is a deeper crisis. Now, how do existing, what are the existing practice in India? Now, while luckily we have not gone to a situation whereby in India many companies have gone bust, or such a situation would have arisen, but given the 1938 regulations, what they specify is that for a company which is right now doing business, now if a situation hits and company is no longer solvent, or their solvency is being going worse, the first step of action is to, firstly is to intimate IRDI. And you need to inform IRDI maybe by quarterly submissions, or once when the actuary finds out that you need to inform the IRDA. Once you have informed the IRDA, the company needs to then go on submitting the financial plan on how they are going to recover. They need to submit a plan of action for the next 6 months on what they are going to do about the situation and how they are going to recover from that situation. IRDA reviews it, gives their feedback and recommendation, company goes on implementing it, and then IRDI monitors it till the time the company is out of the crisis situation. Now, the key limitation of this is that while IRDA is giving a timeline of 6 months, but there will be some time in framing the plan of actions, where there will be some times where the IRDA will give the feedback, and also there will be a time lag of, let's say, 1 month, 2 months, 3 months, and which will again have some implications on the deployment of the plan, how quickly we can do it. So again, to avoid this lag, the recovery plan will just skip the situation of intimation. Company needs to submit the plans, IRDA reviews it. These part of the plan can get accelerated because you already have it in place. You have already submitted it to the regulator. Regulator already has reviewed the plan and has approved the options which are there. So these help accelerate the recovery for the company, and thereby helping in a smoother and better journey. So that is the key benefit which I would say the plan has. So the key benefits, which in my opinion today, is that what are the key things which are getting achieved out of implementing a recovery plan. Now, while the regulations do not specify it in India, the companies can do some arrangements in place, and do have some plan in place to avoid such a situation. And the key benefits which we believe are that the first is the increased accountability, whereby all the CXOs and everyone being the recovery plan is being approved by the board. So CXO will have a oversight, and they will have to, we can have someone accountable. Okay, that you are the person responsible for managing the liquidity. If the crisis situation, you will be the person to, take care of it. How, persons can be assigned to each recovery option that, okay, if this option is to be implemented, then who will be the go-to person or who will be the person accountable for implementing the recovery option. So that sort of, it helps increasing the accountability. Early alerts, as we said, that there will be a multiple indicators which the companies will be monitoring. So that will also help to identify any risk early on, and the companies can take actions in a timely fashion. So that is there. Even the regulators can get an easier alert, and if there is any intervention required, and they can do it. They can also do it. Quick and easy deployment, as we discussed on the previous slide as well. That since you already have everything approved and in place, the deployment becomes easier. You already have the regulators approval, you already have some arrangements in place, so you can just, if the situation arises, you can quickly hit those buttons, and then that recovery action can start. And finally, the key benefits that are to be achieved is the financial resilience that will help improve the confidence in the industry, avoid government bailouts, the most important, and I believe the selfish goal of the regulators in implementing it is that to avoid bailing out the companies in such a situation. So yeah, that is from my side on the recovery plan, and I would like to ask audience if they have any questions, or would like to understand on what is happening in the market or anything. Yeah.
That's my job, Yash. Here, let me get the mic to you.
Hi. So my question would be like, what are the key differences when we are setting up the recovery plans between emerging market versus the developed economies?
So as such, to be honest, this is a new regulations which are coming up. So even in the developed markets for IRRD, while the regulation has been issued 3 months before, so it is yet to take place. While insurers have been notified, the implementation is in the 2027. Similarly, CBUAE, the UAE regulation came into effect last year. Last year around middle of last year, July or August. So while the regulators have indicated these, it is yet to be seen. In the emerging markets, as of now, I don't think so many of the countries have adopted anything on the recovery plan. Dirk, if you would like to add anything
Yeah,
on.
maybe I think the ambition and the framework is very, very similar. I think the options that you have may be different in more developed market. For instance, maybe easier to take out reinsurance for a certain part of the portfolio, maybe easier to go into runoff for a life insurance portfolio. So I would say, but that will be different globally anyway. The options that we have to work in such a stress situation may be different, but the general regime will be very similar.
Okay, do we have other questions? Time's up, I see. If someone has a quick question, I might be able to strong arm. No, I guess not. We're out of time. I'm hoping that you will come and ask our compatriots here on stage questions after. This isn't just about compliance, right? This is about operating your business in a risk-effective way. So I think great, interesting content. I'm going to ask you more questions for sure. Let's give everyone a round of applause for these two.